Hi candidate, welcome to another session of Manifested Online Classes. So we are still continuing with the topic of public sector accounting, and specifically in this session, I want us to look on IFRS 23, which is basically one of the international public sector accounting standard applied by the public sector entities, specifically in relation to recognition of revenue from non-exchange transactions. And therefore, the objective of this particular standard here, that is IFRS 23, is basically to establish the principles of measuring and also recognizing the revenue from non-exchange transactions. So what are non-exchange transactions? Non-exchange transactions include transactions such as receiving taxes by the public sector entities, receiving of donations, and also what we refer as the grant and so on. So how should that particular revenue be received in form of taxes, in form of donations, in form of grants, be recognized or basically be measured and recognized by the public sector entities? So first of all, we can say that IFRS 23 establishes the principles of recognizing and measurement, of revenue from non-exchange transactions and exchange transactions, including what we refer as the taxes. We also have what we refer as the donations. We have what we refer as the grants, what we refer as the transfers, etc. For example, when we talk about money which is transferred by the national government to the county governments, that money we can refer to it as a transfer. The national government transfer money to the county government without receiving anything in return. That is an exchange transaction between the national government and the county government. So then we can also proceed and look on the scope of this particular standard here. The scope of IFRS 23. And for this particular standard here, we have said it applies to all the public sector entities which receives now exchange from non-exchange transactions. For example, any entity receiving things like donations, receiving taxes, receiving grants, receiving transfers, and so on. So these particular standards apply to such entities. So we can say IFRS 23 applies to all public sector entities, receiving revenue from non-exchange transactions, transactions, including taxes, donations. We also have subsidies and grants and other transfers Any public sector entity which is receiving taxes or basically collecting taxes from the members of the public, receiving donations, subsidies, the grants and other transfers, then it should account for that money which is received in form of taxes, donations and so on, in accordance with what? In accordance with IFRS 23. Then we can look on definition of few terms. So the first term we need to define here is non-exchange transaction. Non-exchange transaction. Now, an exchange transaction, basically this is a transaction whereby one party will do what? Will give some resources, or in other terms will receive, will transfer. That is, will give or transfer some resources without receiving resources from the receiving party having an equivalent value in exchange. For example, as a member of the public, you pay taxes to the government, but it's not obvious that you're going to receive services from the government equivalent to the taxes you have paid. That is now an exchange what? A transaction. Another good example of an exchange transaction is whereby the national government will transfer money to the county government, and it is obvious that the national government is not receiving some services or even some goods now from the county government as a result of the money which has been what? Transferred. All those are good examples of what? The non-exchange what? A transaction. So therefore, we can say that this is a transaction, in which one party receives value without directly giving something of equal value in exchange, in what? In exchange. And in this case, I've given a good example of this, e.g. a payment of a tax. So basically, I've said, as a member of the public, once you pay tax to the government, it is obvious that the government will not provide services to you equivalent to the amount of tax you have paid. So that transaction between you as a member of the public and the government, whereby you pay tax to the government, purely this is an exchange transaction. So the other term we may also need to define here is the term taxes. So what are taxes? Taxes, basically, we know that these are compulsory levies which are imposed on the members of the public and companies by the government, for the government to be able to raise money to provide, or basically to do what? To pay for the public expenditures. So we can say that this is the compulsory levies imposed by the government, to who? To individuals. In this case, individuals, here we can talk of the citizens, and companies to do what? To fund the public expenditure. So basically, the public expenditure, these are those particular expenditures which are incurred by the government. Like we know, the government has to do what? To provide security to us. It has to employ some security guys. The government will have to pay those security guys. The government also cater for what? For other public what? Expenditures, like maybe constructing public roads and so on. So therefore, as a result of that, the government has to do what? To levy taxes. To be able to fund those particular public expenditures. So that is the second term which you must be in a position to define. The other term, number three, is something called the transfer. Now, even before we define this, remember I've said a transfer is, for example, where the national government will transfer money either to public schools, to county government. For those public schools, the county government to provide what? Some services to the members of the public. So once the national government transfer that money to the county government, to the national schools and so on, or to the public schools, the government do not receive anything in return of the money transferred. So that is a good example of what we further a transfer. So we say this is a voluntary all compulsory transfer, all compulsory transfer of resources by one party to another, without receiving goods or services of equal value. So therefore, those are some of the terms which you must be in a position to define in accordance with that particular standard. So then from there we can look on the revenue recognition criteria. So basically these are those criteria which must be met for revenue from non-exchange transactions to be what? To be recognized. In this case, we have two criteria for recognizing this revenue from non-exchange transaction. Number one is that there must be inflow of resources. Inflow of what? Of resources. Inflow of resources. For instance, when maybe the national government or even the county government receive a donation, receive some grant, then that should be recognized as what? As a revenue, because the cash has been received. There is inflow of what? Of resources into that particular public sector entity. And number two, we talk of absence of direct exchange transaction. Absence of direct exchange transaction. So basically, when we talk about absence of direct exchange transaction, it means that the public sector entity is just receiving resources, is just receiving money, but it is not expected to do what? To provide some services, to transfer some goods in exchange of cash which has been received, or in exchange of the service resources which have been what? Received. So those are the two criteria which must be met for revenue from non-exchange transactions to be recognized. Finally, we can look on the measurement of revenue from non-exchange transaction. And the revenue from non-exchange transaction, this one should be measured, or in other terms, it should be recorded in the books of account at the fair value of consideration receivable. So we can say it is recognized, or in other terms, it is measured at the fair value of consideration received, all consideration which is receivable. Which is what? Receivable. So therefore, that's how that particular revenue from non-exchange transaction should be what? Should be measured. So therefore, those are basically some of the issues you need to know as far as this particular standard, that is IFRS 23, is concerned. So before we wind up, there is an assignment I want to give here, coming from this paper here, April 2022. Specifically, this was a question number 1A, and I can read the question. It reads: International Public Sector Accounting Standard IFRS 23 revenue from non-exchange transactions, which include taxes and transfer, prescribes the requirement of financial reporting for revenue arising from non-exchange transaction other than non-exchange transactions that give rise to an entity's combination. Required. In context of IFRS 23, describe the following. Number one, the measurement and recognition of revenue from non-exchange transaction. Number two, measurement of asset on initial recognition. And three, condition for recognition of a present obligation as a liability. So, and the examiner, as far as those three questions are concerned, had given six, or actually a total of 8 a total of 8 marks. So therefore, what you need to do, make sure you attempt that particular assignment. And equally, I also encourage my students to get this particular revision kit here. It is updated to the most recent sitting. So get this one. Basically, you'll be able to get the solution for all these particular assignment I'm giving. So all the solutions are at the end of that particular revision partner or that particular revision kit. So that is the end of that particular session. So see you in the next session as we look on the other standard.